Good morning, everyone. We're going to get ready to start. My name is Emilio Escandon. I'm MBAF's Managing Principal of our Northeast region. It is my pleasure to welcome all of you to our tax reform update. Joining me from our Miami office is Mike Farra. Mike is our chairman of our National Tax Service Line. Joining me in New York City is Gary DuBoff. Gary is a tax principal with extensive knowledge in high net worth clients and individual taxation. Before we get into the program, I wanted to cover a couple of housekeeping notes. You can download the slides by clicking handouts just to the right of your screen. And you can also submit questions by clicking questions also to the right of the screen. We have an ambitious agenda. We've scheduled our webinar for an hour, but we may go over, and if we do, we'll leave the webinar open for approximately 15 to 20 minutes to address your questions. Gary's going to be covering the tax revisions affecting individuals. I'll be covering qualified business and pass-through deductions. Also a brief overview of excess business loss rules, and then a laundry list of tax revisions affecting business entities. We'll then turn it over to Mike, who'll be covering the provisions affecting international tax, and then back to Gary with a brief overview of estates, trusts, and gifts. And with that, I'll turn it over to Gary.
Thank you, Emilio, and welcome everyone. As we all know, the Tax Cuts and Jobs Act was passed by Congress on December 20 and signed by the President on December 22nd. The congressional intent of this law was tax simplification. However, as the process evolved, Congress seemed to have forgotten what it means and opted for an elimination or suspension of many deductions as we know them, and also added complexity to the new law with provisions that have very little guidance in many cases. We'll talk more about that later. As we go through the slides today, take a note that most of the provisions of the Tax Act are effective as of January 1. However, due to legislative scoring and congressional budgeting, many of the provisions will sunset and revert back to the 2017 law in 8 years at the end of 2025. To the extent there's a provision that was made permanent or has a different effective date, it'll be denoted on our slides. So we have a lot to cover, so let's dive into the changes as they affect individuals and their 2018 tax returns. The slide you're looking at right now represents the tax table for married filing joint and single taxpayers on a side-by-side basis with both tax brackets and tax rates for both 17 and 18. Note that this schedule represents the ordinary income tax rates, and there have been no changes to the preferential 20% rate on qualified dividends and long-term capital gains. On the bottom right, you can see that the top individual tax rate was lowered from 39.6 to 37%. If you compare the 17 and 18 tax brackets, you'll see that 6 out of the 7 brackets were expanded. Seemingly, these new rate tables would produce a tax cut for the wealthy. But for the changes in itemized deductions, which I'll cover in a moment. On the right, you can see that the 10% and the 35% tax rates are the same, and that the other 5 rates are actually lower than in 2017. And also note that the top rate for a single taxpayer begins at $500,000 and a married taxpayer starts at $600,000. In effect, a combined $600,000 married taxpayer would get a $100,000 tax bracket bonus for being married. Having said that, there's still a penalty if 2 higher earning singles decide to get married. So let's talk. Next slide, please. It's not converting. So let's talk about taxpayers who don't itemize their deductions. The standard deduction increased from $6,350 to $12,000, and for single, and $12,700 to $24,000 for married filing jointly. And the personal exemptions of $4,000 per person or dependent were suspended. Think of it this way. If you were single and you had 1 child, you would be in the same position that you were in under 2018 tax law. $6,350 plus $4,050, and 2 dependents of $4,050 each. So you're a little bit higher. With regard to married filing jointly, it's essentially 1 child and a couple would be equivalent. So they're not giving you much of a benefit as a result of increasing the standard deduction. Let's talk about medical expenses. In a strange last-minute jockeying by Congress, the medical expense deduction found a new life. It was actually slated to be eliminated as of the end of 2017, but in fact, it was not only given a new life, but it was retroactive back to 2017, enhanced through 2018. The change that was made was that regardless of what your age, the 7.5% floor on itemized deductions will apply, and there will be no adjustment for AMT. One thing to note on that slide with regard to medical expenses is that medical is actually dead after 2018. Beginning January 1, 2019, there will be no longer a medical expense deduction. Next slide. You must be living in a cave if you didn't hear the media buzz all at the end of the year with regard to state and local taxes and real estate taxes being limited to $10,000. I received many phone calls from my clients during my Christmas holiday with last-minute instructions on what to do with regard to their state and local and real estate tax deduction. This is an unfortunate loss of a deduction for many of our clients, and it impacts predominantly those with, who have multiple homes or live in states that have higher tax rates. It's a huge impact. However, many of those clients were in the AMT and didn't really get the true full benefit of those state tax deductions. So that remains to be seen what the impact will be. Also note that there was a provision made wherein foreign homes and real estate taxes on foreign homes is no longer tax deductible, nor is income tax foreign income eligible for a deduction. You're still eligible for a credit on foreign taxes paid. Also note that as far as these expenses are concerned, it really only applies to individuals and personal expenses. These are still deductible for Schedule C businesses, Schedule E, and Schedule F business farms. I'll also point out in a later slide that these also apply to trusts. Let's talk about the mortgage interest deduction. If you have a home mortgage of $1 million, that mortgage is grandfathered, effective with the new law. If you were fortunate enough to buy another home, and that home was purchased or had a contract, a binding written contract before before December 15th, 2017, you still have until April 1st to close on that home in order for that mortgage interest to be grandfathered. Also note that the new rules are $750,000 mortgage interest deduction on home acquisition indebtedness. And for those people who are single, married, filing separate, and had a household, it's half of that, $375,000. So a lot of our clients who own homes are going to be impacted by this deduction. Also note that refinancing of that $1 million or the $750,000 could be impacted if there was a major modification of that home mortgage. The home equity loan interest deduction of $100,000 is suspended. For most taxpayers, that wasn't a significant deduction to begin with because it's only the interest on the first $100,000. However, what's important to note here is that the interest tracing rules on a home equity line of credit are still tax deductible to the extent that these expenses are attributable and traceable to an investment or a business. You can still deduct the interest as long as you can do it within a certain time frame of actually borrowing that money against your home. The casualty loss deduction is suspended except for presidentially declared disaster areas. This is going to be a major hit for many of our clients who have had theft or casualty, flood, fire. And if you have a situation that's not a widespread event such as a earthquake or a flood or a hurricane, you're most likely not going to be able to have the government support your deduction. Let's talk about some of the other miscellaneous itemized deductions. This is a huge suspension of a deduction that impacts many of our clients. Again, if you're subject to the AMT, you were not going to get a deduction for your expenses that exceeded the 2% floor. But what we're talking about here is the investment advisory fees and related investment expenses, unreimbursed employee business expenses, as well as what's near and dear to us, tax preparation and other tax-related professional fees, legal fees, other fees that are connection with taxes. So that's going to be a huge loss for many of our clients, and is going to be, that also applies to trust, and we'll talk more a bit about trust later on. The 3% P's limitation, which was an adjustment of the itemized deductions, which essentially reduced itemized deductions for high earners above certain levels, that's also been suspended. This, in effect, is actually a tax benefit for many of our clients who had high adjusted gross income. And that was sort of a hidden tax that many clients were subject to that was really not a good tax policy decision, and it was eliminated. So what hasn't changed? Charitable donations, in a sense, haven't changed from the prior law. The only change that was made was an increase from a 50% of AGI deduction to a 60% AGI deduction for cash contributions. All the other rules under charitable contributions still remain. So this is one of the only opportunities for many of our clients to take advantage of, because it's the only discretionary deduction that's still available. When you think about it, you have your real estate taxes. They must be paid, and they generally are paid at a certain time. You have your state taxes. They're all capped at $10,000. So the only real discretionary deduction you have left is the charitable donation. So we see this as a great opportunity for many of our clients, and that these deductions will actually bring on lots of opportunities to do donor advised funds and a number of other charitable planning techniques, including charitable trusts. Let's make a couple of observations with regard to itemized deductions, because this is really one area where a lot of clients, you know, if they don't have charitable donations or high mortgage interest or investment interest expense, which, by the way, was not changed whatsoever, they won't be able to itemize. They're going to be subject to a standard deduction, which, as we pointed out before, isn't really as beneficial as it would appear. Another observation is that the net investment income tax, which is the NIT tax, which is a 3.8% tax on investment income, may actually increase due to the loss of both the 2% and the state and local tax deductions. So that's you know, going to be another hidden increase for many of our clients. At a minimum, their tax will be higher for their NIT tax as it was opposed to 2017. Also, we really haven't identified what the full impact of this is, because it all depends on what state you may reside in. But many taxpayers' state income taxes, which are subject to essentially start with federal taxable income, will be impacted. So to the extent you live in a state such as New York that does allow for itemized deductions, that will have an impact on your tax. Obviously, other states or no tax or low tax states won't have an impact. With regard to investments, you know, to the extent what we just described, the loss of all the itemized deductions really is in effect, you know, even though the tax rate table is lower, at the end of the day, many taxpayers will have a higher effective tax rate. So if you live in a state which subjects its residents on tax on its out-of-state muni bonds, in-state muni bonds will provide a greater after-tax yield. So there are a number of other changes that were made that don't affect itemized deductions, nor do they affect the tax rates. They are really just true deductions and income items that were changed under the new law. And this one is a big surprise to many people, including myself. Alimony is no longer deductible effective January 1/19. Congress gave us a one-year window with which for taxpayers who are undergoing a divorce to complete them before the end of this time frame. Effective 1/1/19, alimony is not deductible, nor is the recipient taxable on the alimony. This provision does not sunset, so this is a permanent change, at least to the extent there's no changes in administration. Moving expenses are no longer deductible, nor are they excluded from income if they're paid by your employer, except for those members of the armed forces. This is an important change. Like-kind exchanges are limited to real estate tax, to real estate only, and this also applies to businesses, but in the past, under old law, not only was real estate eligible for like-kind exchange, but airplanes and art and other assets were eligible for a like-kind exchange. Entertainment expenses are no longer deductible. Be careful with this because entertainment is really limited to pure entertainment, things like athletic events and Broadway shows and tickets to theater and anything that has any sport events are no longer deductible. But however, just point out that meals and travel expenses are still deductible. There are going to be changes to the meal expenses for employees in the office. There's going to be some changes, so I would suggest that you talk with your tax advisors as it relates to a business that has meals and employees. Small sacrifice on the members of Congress. They took a hit on the chin. Members of Congress can no longer deduct their living expenses away from home. So we got through the itemized deductions and the other items of income. Let's talk about the actual tax calculations and credits. The President declared that the alternative minimum tax would be repealed and is dead. However, Congress decided that they were going to retain it for individuals. They did eliminate alternative minimum tax for corporations. However, they increased the exclusions and the phase-outs. So at the end of the day, many clients, many taxpayers who no longer have state and local taxes or miscellaneous itemized deductions to contend with will no longer be subject to the AMT. In fact, charitable deductions might actually be worth more than they were in 2017 under old law. If you were subject to the AMT under the old law, the most your charitable donation would be worth at the highest tax bracket would be 28%. But under the current law for 2018, charitable deductions could be worth substantially more, as much as 37%. Another item that might impact those people who are often subject to the AMT but will no longer be subject is incentive stock options, which is a preference item for AMT purposes. So to the extent you're an executive that has ISOs, you might want to consider what your option exercise strategy looks like going forward. Another change in the tax law, which I think is an important one, is the kiddie tax. The kiddie tax is the tax that's on dependent children under the age of 24, students, for example, who are living at college or at home, who are subject to the parents' tax rates. It was a convoluted calculation that, for the most part, was very difficult to calculate, and the results would be different depending on what the parents' tax rate was. That's been changed and modified. The definition of a kiddie is not modified, but the definition of what is the calculation of that tax it was changed to the trust and estate tax rate table. That tax rate table is an extremely compressed table, which at $12,500, you enter into the highest tax bracket of 37%. It was also changed from 5 tax brackets to 4 tax brackets. But at the end of the day, $12,500 is going to lead you to the highest tax rate. So you could actually have pay more tax or less tax depending on what your parents' tax rate was under the old law. Last but not least, under credits, we're going to talk about the child tax credit. I believe I mentioned before that because the personal exemptions have been eliminated for large families, a lot of the taxpayers and people with large families were hurt by the standard deduction and the elimination of those personal exemptions. Well, the quid pro quo to that was to have an increase in the child tax credit. The age of a child for this purpose is under the age of 17. It was originally under the law. There was one of the plans was to increase that to 18, under 18, but now it's still under 17. And the phase out on those credits is actually substantially higher than it was before. So it phases out beginning at $400,000, and I think it's fully phased out at $440 for marriage filing jointly and $240 for individual single taxpayers. And the good news for those taxpayers who are eligible is that a portion of that credit is actually refundable. So to the extent you don't even have an income tax, you'll still be eligible for that credit and receive a refund. The one caveat under the law is a provision that says that you must provide a Social Security number and it must be reported prior to the filing of the tax return in order to be eligible for this deduction. A couple of other notable changes. I guess you'd call them non-tax. The unwinding of a Roth IRA conversion is eliminated. That means that if you were to convert your Roth IRA, rather an IRA into a Roth IRA, you had until the due date of your tax return to actually make a decision as to whether or not you wanted to convert. If the value of the assets went down at that point, you could have recharacterized it back into a regular IRA. That's no longer available for any taxpayer. However, if you contribute money to a Roth IRA and it turns out that you don't exceed, or rather you exceed the threshold for having a Roth IRA, you can recharacterize that back to a regular IRA. Also, the Section 529 plans have been expanded. Not only the definition of what a education expense is, meaning they could be both private and public organizations, but also to the extent you have children that are in the kindergarten through 12th grade, they're also eligible. For example, private schools can be, 529 plans can be used to fund those expenses. However, the one caveat with regard to K through 12 is that amount is capped to $10,000 per year, whereas college is unlimited. Another change, which will be effective January 1/19, is the individual penalty on health insurance. The Obamacare penalty will be eliminated effective 1/1/19. 2018, however, if you don't have health insurance, you'll still be potentially subject to that penalty depending on your income level. And last but not least, under inflation, many of the exemptions and tax rate brackets are subject to inflation adjustments. However, under the old law, there was the All Urban Consumers CPI Index. And under the new law, they've changed that index to the Chained CPI Index. This is just an index that takes on a different economic background and effectively is a slower CPI index. And that doesn't sunset, so that's a permanent change in the tax law. The next two provisions of the law are game changers for business owners, and Emilio is going to cover these two items in more detail. I'll only say that both of these provisions of the law are ones where Congress increased the complexity and added mountains of uncertainty. And we're hoping that the IRS will provide us with much needed guidance quickly.
Gary, it seems that Congress was trying to achieve simplification via elimination. They eliminated the piece limitation, they eliminated itemized deductions. So it looks like Schedule A in the future is going to look a little bit different than it does now.
Yeah, that's right, Emilio. Actually, after the medical deduction expires in 2018, beginning in 2019, the Schedule A, which is the itemized deduction schedule, which today has 30 lines, could very well be half as many lines, if not less. The only deductions that will be left will be state and local taxes and real estate taxes capped at $10,000, home mortgage interest, charitable donations, and potentially casualty losses and some what we call miscellaneous itemized deductions not subject to the 2% floor, which I'll talk about more when we get to trusts.
Okay, thank you, Gary. Before moving on to the pass-through deduction slides, I'm reminded that the talk about tax reform, and namely reducing the corporate tax rate for U.S. public companies and multinationals, is what prompted the rally cry of, what about the family-owned businesses? What about small businesses? And what about sole proprietors? And this was the genesis for the pass-through deduction. In its simplest application, and there is some simplicity to the math, the deduction is equal to 20% of qualified business income from a pass-through entity. That being an S-corp, a partnership, an LLC treated as a partnership, an LLC that elects to be treated as a corporation that makes an S-corp election, and also amounts reported on Schedule C for sole proprietors, Schedule E, and Schedule F. The QBI deduction cannot exceed 20% of modified taxable income. What I mean by modified taxable income, it's taxable income before the QBI deduction, then subtracting net capital gains from it. So whatever that base is, if 20% of that base is less than 20% of qualified business income, then you're limited to that amount for the deduction. A QBI deduction will never create a net operating loss. The QBI deduction effectively reduces the top 37% tax rate to 29.6. It's only available to businesses that operate domestically. It also applies to trusts and estates. So to the extent a trust receives a K-1 from a business in which they own an interest, in which it owns an interest, and that business reports QBI, the trust will also be able to benefit from the deduction. Number 6 is for the practitioners and tax preparers listening in. The QBI deduction is not an above-the-line deduction, i.e. it won't be shown on page 1 of the 1040. It's not a below-the-line deduction. It is not an itemized deduction. It will more than likely be reported after taxable income and arriving at the base for which the tax rates will be applied. REIT, publicly traded partnerships, and co-op dividends also qualify for the 20% deduction. So how does it work? Of course, you know there's exceptions. The base formula applies when a married filing joint taxpayer has taxable income of less than $315,000. If that's the case, then the QBI deduction is exactly what that first formula was. 20% of QBI will be your deduction. And we'll have some examples to illustrate these differences. For other taxpayers, single, head of household, et cetera, the threshold is $157,500. If you remember what one of Gary's first slides was, the tax bracket, there's actually a tax bracket for the $315,000 / $157,500 bracket. That tax rate is 24% starting in 2018. What a 20% QBI deduction does is it effectively makes that tax rate 19.2% for somebody, for a married filing joint or other taxpayer in that bracket. So what if taxable income is more than $415,000? Well, here's where some of the complexity runs in, but again, the math is somewhat simple. The deduction is limited to 20% of QBI or the greater of 50% of your W-2 wage base paid by the business, or 25% of that same wage base plus 2.5% of original cost of qualified property. One early version of the law didn't have the 25% and the plus 2.5% formula in it. But when the real estate lobby, and the rumor has it some members of Congress realized that they had real estate businesses that used management companies to run their real estate business and didn't really have a lot of W-2 wage base, they said, wait a second, we got to come up with an alternative for those kind of businesses and possibly other businesses that are capital intensive but maybe a flatter organization and don't have that big employee base. So that's the reason and kind of the origin of adding that additional 25% of W-2 wage base and the 2.5% original cost of qualified property. And again, we're going to have an example that will hopefully drive that point home. So what is qualified property? Depreciable tangible property that's still in service at the end of the taxable year used at any point in the production of QBI during the taxable year, and it still has a depreciable period that has not ended before the close of the taxable year. In general, everything except land and intangible assets should qualify. Software should qualify, and most fixed assets should qualify. All right, there is a big carve-out. The QBI deduction is unavailable to specified service business owners if their taxable income exceeds $415,000 for married filing joint or $207,500 for single head of household, etc. You're going to have to read along with me. Specified service business is any trade or business involving the performance of services in the fields of health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services, or any trade or business where the principal asset of such trade or business is the reputation or skill of one or more of its employees. Let me catch my breath. What does that mean? I guess a doctor's practice definitely won't qualify. An S-corp owned by 5 doctors that houses a doctor's practice probably won't qualify. But what about the partnership that owns the surgical center of which those same 5 doctors are partners in? That should qualify. And what about if the S-corp or partnership owns a professional sports team? It would appear that that pass-through entity, the income from that pass-through entity would not be QBI. But what about the partnership that owns the stadium where those players play? It would appear that that partnership should qualify for the QBI deduction. So once you get over the $415,000 threshold, married filing joint, $207,500 for a single head of household, etc., if you're a specified service business owner, you do not get the deduction. If the taxable income is between $315,000 and $415,000 specifically for a specified service business owner, then it's phased out pro rata. If I can stay on that slide a second, one of the earlier versions of the definition of specified service business included engineers and architects. And at the last moment, they were removed from the definition. And again, we think that that's the power of the real estate law because engineers and architects do a lot of work in the real estate industry. So the way it'll work starting in 2018 is the preparers of S-corps and partnership returns will actually make the QBI wage-based and asset-based calculations and then report those amounts to the respective K-1s of those shareholders and or partners. Then those amounts will be combined on Form 1040 or 1041 as one. As of now, no forms have been created. And number 14 has a list of items or items of income that will not qualify for the pass-through deduction. Namely, their investment type or passive in nature. So will there be opportunities to transfer ownership in your S-corps and partnerships to your children or trust for your children in order to minimize the taxable income thresholds at the shareholder partner level? Yeah, there probably will be. But we're suggesting that only if it's part of a comprehensive estate planning. If it's only to maximize the QBI deduction, keep in mind this sunsets at the end of 2025 and to go through a lot of machinations in order to drive down that taxable income threshold may not make sense. Clearly, there will be a lot of intellectual brain power devoted to finding ways to reducing taxable income under these thresholds. The flow chart is for reference purposes only. It's a good visual. The first part of it on the left side, if it can be broken down into three quadrants, is applicable to everybody. From the Uber driver that files a Schedule C, to the doctor, to the accountant, to the attorney, etc., to the widget maker, etc. Because income is below the threshold, the pass-through deduction is 20% of QBI. The middle of the flow chart is specific to those specified service business owners, where there's a phase out over the $100,000 delta between $315,000 and $415,000, and then completely phased out if you're over the $415,000. The right side is for all those operating businesses that operate in a pass-through entity or reported in Schedule C, E, or F. So some examples. Example number 1. Rebecca reports $500,000 of taxable income before the QBI effect on her married filing joint tax return. Obviously, the $500,000 exceeds the $315,000 threshold, therefore the wage base and the depreciable property matter. She owns 100% of an S Corp that manufactures furniture, but she doesn't own any of the depreciable property, she rents it all. The S Corp pays Rebecca $100,000 in wages and has 2 employees and pays them $120,000 together. So the S Corp generates $400,000 of QBI and reports 100% of it on Rebecca's K1. If you stop there, her tentative QBI deduction is 20% of the $400,000 or $80,000. But only if her wages or the wages paid by the S Corp exceed $160,000, 50% of the $160,000 would be $80,000. Well, her total wages, or the total wages paid by the S Corp, are $220,000. The $100,000 paid to her and $120,000 paid to the employees. So Rebecca gets to take the $80,000 QBI deduction, reducing her taxable income from $500,000 down to $420,000. And think of the QBI deduction almost as an exclusion. Compare to example 2, which has the same facts as example 1, except Rebecca runs her manufacturing business as a sole proprietorship and pays her 2 employees $120,000 in wages. She owns manufacturing equipment with a original cost of $1.4 million. So that's the 2 differences. Rebecca's QBI would be $500,000, and she should tentatively qualify for a $100,000 QBI deduction. However, the wage base for the sole proprietor is only $120,000. So when you multiply $120,000 times 20%, you get a $60,000 QBI deduction, tentative QBI deduction. Compare that to now the fact that she owns all of her machinery and equipment with an original cost of $1.4 million. So 25% of the $120,000 wage base is $30,000. 2.5% of the $1.4 million is $35,000. So Rebecca's QBI deduction in that calculation is $65,000. $65,000 is more than 60, but $65,000 is less than the 100. Rebecca gets a $65,000 deduction. And unfortunately, sole proprietors are not allowed to pay themselves wages. So that's a difference between being an S Corp and being a sole practitioner reporting on Schedule C. Compare that to example 3, where Rebecca runs her manufacturing business through a partnership, wherein she owns 99% and her husband owns 1%. Instead of wages, the partnership pays Rebecca a guaranteed payment of $100,000. Partnerships are not allowed to pay their partners wages. Still pays her employees $120,000, and so the partnership generates $400,000 of QBI. Rebecca's tentative deduction would be $80,000, 20% of the $400,000, but only if the partnership paid at least $160,000 in wages, like it did with the S Corp. Well, it doesn't. It only pays $120,000 in wages. The guaranteed payments are not considered wages, and therefore Rebecca's QBI deduction is $60,000, 50% of the $120,000. All right. So the new law is favorable if you have pass-through income and they want to provide for the QBI deduction. But if a pass-through has significant losses, then the excess business loss rules may create some tax issues for investors and some real estate professionals that get significant losses run through their K1s. There's very little guidance on excess business losses. Unlike the QBI, the pass-through deduction, where there was an ample amount of committee report language and examples, there's absolutely nothing available related to the excess business loss rules. It's recognized by non-C corporations, meaning it could apply to Schedule C, sole proprietors. If it's in excess of $500,000 for married filing joint or $250,000 for everybody else, that excess is somewhat suspended and added as a net operating loss going forward. So for that, say, real estate professional who's used to getting $1 million W-2 from his or her management company, but then is also getting a K-1 from some of the real estate ventures or partnerships that show $1.5 million of losses, in 2017, they would end up washing or netting the $1 million W-2 against that $1.5 million K-1 that shows the loss. Going forward, that $1.5 million K-1 that shows the loss is only going to be limited to $500,000. So it's only going to be able to offset $500,000 of the W-2. This is what this rule could potentially mean for some of our clients. In the case of partnerships or S corporations, the provisions apply at the partner or shareholder level. The excess business loss rules are applied after the application of the passive activity loss rules. So this is for losses that are non-passive in nature. And like I said, it looks like it would apply to Schedule C filers. All right, quickly run through some business entity tax revisions. The top part of the screen shows the current corporate tax rates. And then we all know that for 2018 and forward, and permanently, this is not sunset. In 2025, the corporate rate is a 21% flat tax rate. Fiscal year C corporations can benefit from a blended corporate rate, meaning if you have a June 30, 2018 fiscal year end, the first 6 months of your year will be calculated under the old rates, and the last 6 months of your year will be calculated at a flat 21%. However, you will have to do pro rata allocation between the 12 months. You will not be able to close the books. You will not be able to cook the books. Whatever your taxable income is for the whole year, you take 1/2 of that subjected to the old rates, and you take 1/2 of it and you subject it to the new 21% flat rate. It's worth mentioning that for C corporations with taxable income of less than $90,000, the 21% flat tax rate actually represents a slight tax increase because of the graduated rates you see in the table. All right, big laundry list here. AMT has been repealed for C corps. That's one other provision that does not sunset. Mike's going to talk about the 30% limitation on interest deductions. Keep in mind, it's not applicable if gross receipts are less than $25 million. Small businesses don't have to worry about the 30% limitation on interest deductions. Similarly, for businesses with $25 million or less in gross revenue, it's easier to qualify for the cash method of accounting. The DRD deduction was modified due to the new lower 21% effective rate. 100% bonus depreciation deduction was enhanced. It now applies to assets, or it applies to assets in service after September 27, 2017. So if any purchases were made in that last quarter of the year, they would qualify for this 100% bonus depreciation deduction. It's now applicable to both new and used qualified property, and it's scheduled to phase out over 5 years after 2022. The Section 179 deduction increased to $1 million with higher phase outs. Gary already mentioned like-kind exchanges limited to real estate only. Net operating losses generated in 2018 through 2025 cannot be carried back, but they can be carried forward indefinitely. They do not expire. However, those NOLs, 2018 through 2025, can only offset 80% of future taxable income. There was a carve-out for the NOL rules. Full NOL carry-forwards and carrybacks are still available for farmers and P&C insurance companies. All right, I'm going to turn it over to Mike at this point.
Thank you, Emilio. Emilio and Gary just went over the tax savings provisions of the Tax Reform Act. I wanted to give you the tax-raising provisions of the Tax Reform Act, which mainly affect the international area and foreign corporations. I'm going to discuss the new repatriation tax, which is a one-time tax on foreign earnings that have been accumulated. A new tax, which is the GILTI tax, and GILTI doesn't mean that you're guilty of doing something. It means global intangible low taxed income. I'll tell you how that applies, and how we're moving to a quasi-territorial system of taxation from a global system of taxation that we have now, with 100% dividends received deduction and the participation exemption. There are some incentives for for U.S. companies that are doing sales internationally through the foreign derived intangible income. A tax planning tool that we have used in the past is this 30-day CFC rule that has been repealed, and some other significant tax changes that you will learn about. Now, as part of the transition to move from a global tax system to a territorial tax system, they imposed a law that accumulated earnings of foreign corporations that are owned by U.S. shareholders, the accumulated earnings as of December 31st, 2017 that have not been taxed, will now be subject to a one-time tax. If the shares of the foreign company are owned by a corporate shareholder, the tax rate is 15.5% if those earnings have been converted to cash, and 8% if those earnings are in non-cash, been reinvested in property, plant, and equipment, and other assets. The rates differ. If you're an individual shareholder, it will be 17.5% for cash and 9.05% for non-cash. Now, they did allow for an installment payment plan for this. You can elect to pay it at one time, a lump sum, or you can elect to pay it over an 8-year period with different percentages throughout the eight-year period. I'm sure you have read the newspapers and you have seen that Apple announced that they charged to earnings of $38 billion, Citigroup, $22 billion, Goldman Sachs, $4.4 million. Just between those three, that's about $65 billion between three companies. This is exactly what Trump wanted to achieve. Now, they did not announce whether they're going to do the payout over an 8-year period, which I would think that they would do it. And the payout over the 8-year period carries no interest. So I would presume that most companies were going to take advantage of that. If the stock of the foreign company of the CFC was owned by a C corporation as of December 31st, then you can elect to defer the payment of the tax. You can elect to pay the deferment of the payment of the tax if it were owned by an S corporation. So let me say that again. If the stock of the CFC were owned by an S corporation as of December 31st, 2017, the S corporation can elect to defer the payment of the tax and not pay the tax at all now and defer it until a triggering event. And the trigger event generally would be if the company ceases to be an S corporation, there's a liquidation or sale of the assets of the company, or a closing down of the business, or a transfer of the shares of stock of the S corporation by the shareholders. If there's a triggering event, the S corporation then can elect to pay the tax over an 8-year period. So the repatriation tax is a one-time tax. We want to change the slide. Okay, the repatriation tax is a one-time tax. So Congress created another tax, which is the global intangible low taxed income, now commonly referred to as GILTI tax. And the GILTI tax imposes a minimum tax on certain foreign income. The concept behind it is that if a company has more than 10% of their assets, that the companies that have at least 10% of business assets, those business assets can be excluded. And if a company, the excess of that would be considered to be an intangible asset and therefore subject to tax. So the computation is simple. You take the net income of the company and then you deduct from that 10% of your tangible assets. To that number, you are allowed to exclude 50%. GILTI gives you a 50% deduction from that income. And then the remaining tax, if you're a corporation, the tax rate will be 21%, therefore making the effective tax rate to corporations on the GILTI income 10.5%. If the company is owned by an individual shareholder or an S corporation that passes through the income, the tax rate would be 37%, bringing the effective rate to 18.3%. So in this instance, it is recommended that C corporations own the foreign subsidiary, and if you have an S corporation that was in the middle, to avoid the payment of the repatriation tax, a C corporation should be placed between the S corporation and the CFC, so that the C corporation benefits from the lower 21% rate. And thereafter, I'm going to talk about the dividends received deduction, so that they can basically bring that money in tax-free. This is effective for tax years beginning up to December 31st, 17, and it's another way of raising revenue in the foreign sector. The participation exemption, or the dividend received deduction, takes effect that income that is not otherwise GILTI taxed or any other category of subpart of income can be repatriated free of U.S. tax to a C corporation shareholder. This is accomplished through the dividends received deduction. Now, this rule applies to domestic corporations that own at least 10% or more of foreign subsidiaries. Again, effective after December 31st, 2017. The incentive that they created for U.S. companies that have foreign sales is the new foreign derived intangible income, FTII, and generally provides a deduction of 37.5% of the foreign derived intangible income is taken as a deduction. And if a C corporation is generating this income, it would pay the 21% tax rate, basically reducing the effective rate to 13.125% of the federal derived intangible income. FTII is income attributable to the sale of property to foreign persons for use outside the U.S. or to services to persons outside the United States. So it's encouraging the export of goods and services outside the United States. In order to do the computation, you need to determine what deemed intangible income is, and the deduction eligible for the income is 10% of the qualified business asset investment. The qualified business asset investment is the average of the adjusted basis of tangible property used in a trade or business. Similar to the GILTI tax, but it's like the reverse of the GILTI tax, and this is effective for taxable years beginning after December 31st, 2017. For many years, tax practitioners have used the 30-day CFC rule, which basically states that a U.S. shareholder would not be subject to subpart of income if it did not own the stock of the CFC for 30 days or more during the year. This provision was used many times when a foreign corporation was owned by a foreign individual, and a U.S. individual would inherit the shares of the foreign corporation. Then during this 30-day period, the new U.S. shareholder would be able to do a check-the-box election to treat it as a transparent entity, and he would get a step-up in basis in the assets of the entity, and the entity would become a flow-through entity. By getting the step-up in basis, you cleanse all the unrealized gain that is there, and it would be at zero tax cost. This 30-day rule was repealed, so this strategy is no longer available. On other outbound changes, many clients have used the IC disc. It's an interest charge disc, and that provision was not repealed. That's still available, and it is of use and very convenient. Section 956 deals with investments in U.S. property by a controlled foreign corporation. This section provides that if a foreign corporation invests in U.S. property, it will be treated as a dividend to the shareholders. This code section was not repealed. Section 954C6 was not extended beyond 2019. We have had issues with this section before, but other tax provisions and extenders have extended it. This section provides an exception to subpart of income for dividends received by a CFC under a look-through rule. What this basically provides is that you can look through the foreign subsidiaries. If the foreign subsidiaries have operating income, that concept of the operating income can flow through to the upper tier company and not be considered to be subpart of income. New sourcing rules have been put into play. Generally, property produced in the U.S. will be considered on a going forward basis U.S. source income, regardless of the place where title passes. In the past, if a U.S. property was sold in a foreign country, that would be considered foreign source income. Now they're looking at where the property is produced. And conversely, if the property produces outside the United States, it will be considered to be foreign source income. On other outbound changes, Section 958B4 was repealed effective in 2017. Now, downward attribution from foreign persons to a U.S. person is applied. This can make a corporation the shareholder of a brother-sister foreign corporation to the common ownership rules of a foreign parent. On another note, a U.S. shareholder is now determined by 10% vote or stock or value in a foreign corporation. Previously, U.S. shareholders were only those who had a 10% vote of stock. Emilio alluded this to a little bit about the changes to Section 163J. In the past, Section 163J looked for a debt-to-equity ratio of 1.5 to 1, and you had to apply that on an annual basis. Now, the interest deduction would be limited to 30% of adjusted taxable income, basically to adjusted taxable income. Now, this limitation does not apply to small businesses, which are those with gross receipts of less than $25 million. And in order to look out for the real estate industry, they did put an exception that electing real property trades or businesses would not be subject to this new limitation on interest deduction. This includes any real property development, construction, acquisition, generally any real estate trade or business. Now, the new law does not provide any guidance at this moment on how disqualified interest carry forward or unused excess limitations of the old Section 163J will be treated. In the past, if you were not allowed to deduct the interest under Section 163J, you could carry it forward, and when you sold the business or something else happened, you would be able to take the deduction at that point in time. As of now, we don't have any guidance on it, so we'll see whether the IRS will issue some pronouncements. A new tax, it's the beat tax. And the beat, again, is not that we're singing to the beat of something. It's base erosion, anti-abuse tax. And this is like a minimum tax, like the alternative minimum tax. It's a tax that is applied on related party deductible payments. If you pay interest payments, royalties, license fees to a related party, and the combined gross receipts of the companies is $500 million or more, then you have to do a test for this tax. And you have to have deductions to related parties which are at least more than 3% of the overall deductions of the company. The tax applies to domestic payments to foreign related parties. There are payments that are made by a U.S. company and they're taking a deduction, and generally either not picked up in income or otherwise dealt otherwise by the foreign related company. The tax rate is 5% in 2018 and 10% in 2019 through 2025. Now, you have to calculate this modified taxable income, which is reduced by the company's regular tax liability. So the BEAT tax is applied if it is less than the regular tax. If the regular tax is greater than the BEAT tax, then you don't have to pay it the same way like the AMT used to be computed and paid. The B tax is applicable to U.S. C corporations or foreign companies engaged in a trade or business. The base erosion payments do not include cost of goods sold, provided the payments of the cost of goods sold are not to an inverted company, or amounts paid or accrued for services that qualify for use of the services cost method. On other inbound changes, in 2017, the tax court ruled on Grecian magnesite that the sale of a partnership interest would not be taxable to a foreign partner. Well, the Tax Reform Act seems to overrule this court decision, and now the sale of a partnership interest by a foreign partner is subject to tax to the extent the underlying assets are connected with the U.S. trade or business or U.S. assets. This Grecian magnesite case was a very important decision, but I guess Congress felt this was another way of raising revenues. There was talk about changing the tax rate of foreign corporations so that it would be higher than the tax rate of domestic corporations, but they left it the same. Now, disregarded domestic LLCs, as of last year, a couple of years ago, they were first required to file the FBAR forms. Now, effective for 2017, and this was not in the Tax Act. This is just a vignette that we're throwing in. Effective 2017, domestic LLCs that have a 25% controlled foreign controlled company will be required to file the Form 5472, which is an information tax form. Even if the disregarded LLC is not filing an income tax return, it will be required to file the Form 5472 if they are owned by a foreign person. An increase in the penalties for late filing of the Form 5472 is the increase is going to be now $25,000 on a going forward basis. Before it used to be $10,000, and this $10,000 penalty, the IRS has programmed the computers that if you file a Form 5472 late, within 6 weeks of filing the return, you'll be getting the $10,000 penalty. Sometimes we've gotten those penalties waived if it's a first-time violation, but they're being very strict. And now they're going to make the penalty a $25,000 penalty. I'm sure it's going to be tougher to get it waived. So a word of caution, if you have a requirement to file the form because you have transactions with a related foreign-owned corporation, it must be filed timely. So with that, Emilio, I'm going to turn it over to Gary to wrap up.
Okay, thanks, Mike. We're at 12:02, and so we're running just a little late. Gary's going to take another 3 to 5 minutes to go over estates, trusts, and gifts, and then we'll try to answer some questions that have been rolling in. Thank you.
Thanks, Emilio. I know right now there's a conference going on in Miami at Heckerling, which is an entire week long, but I'm going to cover estate and trust in 3 minutes. So what's changed in the estate and tax and gift tax world? One primary change, obviously, there was supposed to be a repeal. The president wanted to repeal the estate tax. However, the estate tax was not repealed. Effective January 1, 2018, the estate and gift tax exemption was doubled to approximately $11.2 million. I say approximate because they're using the changed CPI index in order to calculate what that new exemption will be. And since the actual index hasn't come out and won't come out until February, we don't have an exact figure. But for a married couple, it'll be approximately $22.4 million. Both the generation skipping tax exemption is also matched to match the exact same numbers as the lifetime and the estate and gift tax exemptions. These changes, however, will sunset on December 31st, 2025 and revert back to the $5.6 million, which creates some planning issues for some taxpayers who are over that amount, and we'll get to that in the next slide. On what hasn't changed? Well, the graduated rates and the top estate tax rate of 40% hasn't changed. There's been no change to the step-up in basis or the portability of the exemption rules. There's been no change to the non-resident alien exclusion, or lack thereof, which is $60,000. It has not increased, and I don't believe it increases for inflation. And the only change that would impact you in 2018 would be an increase of the exemption from $14,000 to $15,000. With regard to trusts, I mentioned earlier under the kiddie tax that the trust tax brackets went from 5 to 4. You can see what they are here. The top rate is 37%, and it begins at $12,500. Those brackets are indexed for inflation. Also notable for trusts and estates is that while individuals no longer have personal exemptions, trusts do, trusts and estates, and depending on the type of trust it is, you can have either a $100, $300, or $600 exemption. And I believe there's a $4,050 exemption for disability trusts as well. Trusts, as Emilio pointed out, are eligible for the 20% QBI deduction, and the threshold for QBI for a trust is $157,500, which may provide some opportunities for many clients who want to shift assets and wealth to the next generation. I mentioned earlier the state and local tax and the real estate tax deductions are also subject to the same $10,000 limit as individuals, and that also with regard to 2% miscellaneous itemized deductions, your typical deductions are not allowed under trust law. What is allowed are trust expenses that would have been incurred if the trust property were held by an individual. So would not have been incurred, excuse me. So for example, trustee fees, trust tax preparation fees, distributions in connection with fees in connection with distributions from trusts, those are all still fully deductible, not subject to a 2% floor. In addition, one planning note, to the extent a trust is terminating or makes a final distribution, typically what would happen is that all those expenses that were not deductible at the trust level would pass through to the beneficiary, and as a consequence would be miscellaneous itemized deductions on an individual's tax return. We have to be careful in final years of trust not to, to time it properly so that we don't have excess deductions that will no longer be deductible as an itemized deduction on the individual. That does not apply to capital losses, however. Two other small changes on the trust level. To the extent you have a business that is an S corporation, in the past you were limited to certain types of trust you're still limited to certain types of trust as a shareholder. One of them is an electing small business trust. However, they expanded the definition of who can be a beneficiary of one of those trusts, and a non-resident alien can be a beneficiary of an ESBT trust. And ESBT trusts are now allowed to deduct charitable deductions similar to individuals, whereas before they were limited and in effect were not even allowed under ESBT rules. A couple of observations that I'm going to make. With the doubling of the lifetime exemptions, many taxpayers won't be subject to an estate tax. So clearly, they won't have, many issues. However, it's always a good idea to review your planning. For example, you may have a will that has trust formula provisions, and to the extent there are changes in the exemption amounts, that would have a meaningful impact on the direction and the flow of your assets upon death. However, there is a unique opportunity for those people who might actually be subject to the estate tax on the lower threshold when it sunsets, when the exemption sunsets in 2025. So, for example, if you're married and you have more than $24 million, rather between $12 and $24 million in assets today, in 2025, you'll be subject to estate tax. So it's a unique opportunity for those taxpayers to make gifts during the next 8 years. For those clients, what we call the ultra-high net worth clients, who continue to be subject to the estate tax, regardless of the increase in the lifetime exemption, planning, the typical type of planning that we do for our clients, including GRATs and family limited partnerships and intentionally defective grantor trusts, is still the way to go, and we would encourage our clients to continue making gifts in order to minimize their estate tax exposure. Note that if you live in a state that has its own estate tax that would have decoupled from the federal, you're still going to have to do some planning in order to avoid paying a state estate tax. For example, Connecticut, New Jersey, and New York under current law is still below the the exemption for federal tax purposes. One issue that needs to be addressed by the IRS is that to the extent the law sunsets and in 2025 the exemption gets cut in half, that means that potentially people who would have made gifts during this time frame, this 8-year window, may be subject to an additional tax upon death. And this is just an area where the regulations have been the Congress has given the IRS the mandate to actually address this through regulations. So we should have some answers to those questions forthcoming in the next few months, hopefully in the next year. So that's pretty much all I have that I wanted to cover. It's the end of my formal remarks. I think I did it in under 5 minutes, and I thank you all for listening. Emilio, do we have any questions?
So we have a couple of questions that I wanted to at least cover. There was some uncertainty regarding home mortgage interest deduction and the deduction for home equity line interest. The new rules related to the $375,000 threshold and $750,000 threshold with respect to acquisition indebtedness, that's the amount of the loan. The interest that would be deductible would be related to that $375,000 loan or that $750,000 loan if you're married, filing joint. So at a 4% loan, a single taxpayer can borrow, will probably have to borrow more than $375,000 to buy a home, let's say. They would only be able to deduct 4% of that $375,000, or about $15,000 based on that. There was some uncertainty with respect to is an equity line interest still deductible if used to acquire or improve a home? The answer is
yes. Home acquisition indebtedness to the extent of $750,000 of the new law, married filing joint, is still deductible.
But this is equity line interest. Equity line interest for improvement of a home is personal in nature now, and that would be non-deductible.
No, to the extent you can trace the equity proceeds and reinvest that back into the home in the form of home acquisition indebtedness, it still qualifies.
Okay, acquisition. Including improvements?
Including improvements.
Okay, very good. There was some uncertainty regarding the alimony deduction, so some clarity there. The alimony deduction is not deductible for agreements entered into after 2017, but for alimony agreements signed before the end of 2017, the alimony is still deductible and still includable in income by the recipient. There was an involved question regarding the 2%, the elimination of 2% miscellaneous itemized deduction. We'll have to get back to the participant on that one. And
I have a question.
Sure.
There was a question with regard to what do I mean by doubling up my charitable donations or in order to take advantage of the charitable donation. And I just want to give a quick example. Suppose you're married filing jointly and you have state and local taxes that are capped at $10,000 and you have a mortgage where your interest is $10,000. That would get you only up to $20,000 and your standard deduction is $24,000. So in that year, if you made charitable donations, let's say you made a $5,000 charitable donation, you'd only really get a benefit on $1,000 because your standard is $4,000 higher, or rather is only $1,000 less than the $25,000 combined deductions. If on the other, so you would take the standard deduction in that year, potentially defer your charitable donation to the following year, and in the following year, you would most likely be making 2 charitable donations of $5,000 each. So that would get you to essentially $30,000, $10,000 for state and local, $10,000 for mortgage interest, and then the 2 years combined, $10,000 for a charitable donation. That would get you to $30,000. So over the 2-year period, you get a combined total of $50,000 in deductions, where, 24 and 30, which is $54,000 worth of deductions.
All right. The rest of the questions I think we've answered either privately or online. Very thankful for your attention during the last hour and 15 minutes. And with that, it brings us to the conclusion of today's program. Thank you all very much.
Thank you.